In this video, traders are going to explore why spread betting is considered such high risk. Stay tuned. Hey guys, a very warm welcome to you. Alright, so spread betting is considered high risk. You've seen the disclaimers, the risk awarenesses on the end of the videos, you've seen them on broker sites, you've seen them everywhere, and that is because we don't want anybody to confuse spread betting with anything other than a high risk trading instrument. But why is it high risk? Why is it considered such high risk? So to put it in context, you've got to compare this with, say, investing in shares, okay? Because those are very similar things. Now, you could argue that's not really the best comparison, but we'll touch on that in a second. So if you invest in shares, let's say you have £10,000, you place that into shares, then you're buying an asset. That asset could halve, it could double, it could triple, but whatever happens to that asset, you know, the most you can lose is all of your money. But if you can imagine if you bought a share like HSBC, Vodafone, Facebook, the chance of you losing all your money on some of these instruments are pretty slim. The chance of Amazon going to zero, pretty slim. Chances of some other kind of FTSE 100 company, BP, going to zero, pretty slim. Now, not to say it can't happen. We have instances, of course, where big companies have gone to zero, so there's always inherent risk with any investment, but that's the way we look at it. It's like you invest money, the chances of you losing dramatic amounts, they're slightly higher than perhaps some other instruments, but compared to, say, spread betting, the chances are low. So why is spread betting so much different? Well, the one thing that changes the dynamic of spread betting compared to standard investing in shares, which you would do a traditional broker, is this. It's margin. It's using leverage to trade with. So because of that, it becomes a high risk product. But it's worth bearing in mind, guys, it's up to you how you trade and how you deal with the leverage. Let's look at an example. Let's look at how we can mitigate the risk, how we can minimize the risk, why it's considered so risky. So let's imagine we have £10,000 and we want to trade with it. Now, this is how we mitigate, this is how we mitigate our risk. If we put that into a trading account, we could control £10,000 worth of an asset by using margin. Now, the margin requirement might be, say, 5%. So we could buy £10,000 of the same share that we normally buy, but in the spread betting broker, we'd only have to put up the margin percentage. In this example, it's 5% or £500. So £500 will be allocated as margin requirement. Now, if we had that scenario, we had 10 grand in our account, we had £500, it wouldn't make so much difference what happened. But what happens is that people won't have £10,000 in the account. People might have £1,000 in their account. They're using this margin tool, and of course, all of a sudden, now the dial gets turned up. Let's look at an example like that. So if you had £1,000 in your account, you bought whatever instrument this was, you decided to buy £20 a point at 500 pence. So total notional value, 10,000. That gives you 5% margin. You've got to put £500 up as margin for this trade to control 10,000. Let's look and see what would happen. So this is why it's considered such high risk. You've bought at 500 pence. The price goes up to this point, 520. What happens at 520? You've made 20 points times £20 per point, £400. That's almost doubling your money. Right? You've almost doubled your money in a short period of time just from seeing that going up because the low leverage requirement. Okay, that sounds really good, but then what happens if the market starts to go against you? Well, point two, it comes back to break even. Your profit is zero, and what we call maximum favorable excursion, MFE, was 20 points, but you've lost that now, it's back to zero. You've made nothing. Okay, now it comes down and it's in a dramatic loss situation. You're not doing very well here. You're down to 450, 50 points down, times £20 a point, you're down £1,000. Now, in this situation, you would lose more than your margin deposit. You would have to have posted more to cover that loss and to still cover the margin. Now, the margin requirements are slightly different once you're in the trade, but the point is you still got to have that £1,000 come out of your account. And this is the key, guys, is that if you only had £1,000 in your account and you were doing this trade, you'd have been stopped out by the broker between point 2 and point 3, depending on the broker's closeout requirements, because you haven't got £1,000 to cover the loss and the margin on the trade, so it'll cut it. So at some point between there, you're out of the position. So the leverage has meant you've lost your total account. It's wiped out. But even if you did put more money in to cover that, it could come back to break even here. Maximum adverse excursion was 50 points. comes down again to 5.5, breaks the low. You've lost £2,000 on your trade there because you're leveraged up and you're controlling a £10,000 position. £20 a point, 100 points, 2 grand. And if you had money to put into it, but in normal circumstances, if you didn't, you're just trading with that, you'd be out of the game there. And let's say now it then recovered over the next few weeks and came back up there, then fine. The point is that if you were investing just that 10 grand, yes, you'd have to sit through this swing still, but you're not going to get taken out of the position. It's not magnifying how much you had in your account, which in that example was say 1,000, and you can sit through this. It dampens off the whole scenario. The point is, guys, is that it really magnifies moves. That's what margin does. That's what leverage does. Now, of course, if you use it sensibly and if you're careful and cautious, it's a very, very useful tool for traders, and that's why spread betting is so popular. But if you misuse it, then it can harm you. So of course the disclaimers have to say, hey, this is high risk, you could lose all your money, because if you consider this, it would take you no time at all to hammer through an account and lose a whole account. And that's what happens to traders, because they're using too much margin. They think, oh, well, okay, let's go to that scenario. I've got £1,000 in my account. All right, well, let's use something where I can trade 5% margin, use 500 as margin. But of course, if that draws down by 500, they're out. They've lost that 500. They're down by 500. They probably get taken out of the trade because they can't hold the position. They've got enough money in to hold the trade. So all of a sudden now that's 500, and then they take another trade using 200 margin, and you can see how very quickly your account can be absolutely decimated. Whereas if you were just trading without leverage, you'd buy £1,000 worth of shares. They'd have to go to zero for you to wipe out. They have to do some significant volatility for you to wipe out. Margin basically turns up the volatility. Plus, you've got things, of course, in addition to that, like gap risk. So if you're buying a share and it gaps overnight, or if it gaps over the weekend, some sort of information, sort of news comes out, all of a sudden your position is, because your position is magnified, your loss or your gain is magnified. And then we talk about other more volatile instruments that you can trade via a spread bet. Some of the things that are very, very active. Some things like crude oil is going crazy at the moment. Gold sometimes goes crazy. All these things that are very, very active. Yes, the margin requirement might well be higher, but it still doesn't change the fact that it's super, super high risk. Now, before we go, I just want to point out that you could also compare this to a fixed odds bet. And that's the kind of the two double-sided kind of viewpoint on this. If you were going into a bookmaker's and you were saying, okay, I want to place £1,000 on England to win the rugby match against Ireland, you put your £1,000 on, your bookmaker writes you a little slip, or you do it online, whatever it is, you get your little slip, you tick it. If they win, you win whatever odds. If they lose, you lose your 1,000. You know how it works, and because it's fixed odds, that's the way it is. It's very similar, of course. Now, before, you used to be able to lose more than your initial investment. With new ESMA rules, means that you cannot go into negative balance. If you're a retail trader now, you've got £1,000 in your account, whatever happens, you won't lose more than that £1,000. So that's good for the new retail trader. So it puts it kind of in the category now of kind of fixed odds betting. But of course, that's considered gambling. Whereas if you're comparing this to an investment, as in you're buying shares, then yes, it's very, very high risk. But as long as you can understand the risks, understand how to mitigate the risks, understand how to assess things, how to manage stops and all this kind of stuff, and maybe not using so much margin that you're really leveraged up, it can become a useful trading vehicle. All right, guys, take care. See you next one. Bye-bye.